our last lecture, we looked at the cash payback period as our first tool for analyzing capital investments. One of the problems with the cash payback period, we said, was it doesn't consider profitability. So let's look at another ratio that does consider profitability. Another option we have is the accounting rate of return. Let's look at how that would be calculated using the same situation we had for the cash payback. So as you recall, we had a factory and we had $1 million that we could invest, and we could either invest in equipment to build skateboards or scooters. We couldn't do both, so we had to decide between one or the other. Let's look at the accounting rate of return for skateboards. So the formula is taking the average annual operating income. Now that's different from cash inflows. We're going to take the average annual operating income and we're going to divide by the initial investment. So to get the average annual operating income, we need to take the average annual net cash flows, so the average cash flows, and subtract from it the depreciation expense. So let's look at the average cash flows first. The average annual net cash flows is just taking the total cash flows and dividing by how many years. If we're doing the skateboards first, we see that total cash flows is $1,625,000 divided by 5, and that gives us $325,000. We would have known that anyhow because the cash flows are the same each year. But that's the method that we would use to figure out the average. So we'll put that in the formula. Now let's look at getting the depreciation expense. The depreciation is calculated by taking the initial cost minus the residual value. In this case, we've been given additional information that the residual value is 0. That just means how much we think the equipment is going to be worth at the end of the 5 years that we're going to produce skateboards. And then for the depreciation expense, divide that by the useful life. So the cost of the initial investment is $1 million, the residual value is 0, divide by 5, and we get $200,000. So let's put that into the formula. We've added the $200,000 to the formula. Now we just need to divide by the initial investment. So for the skateboards, we get an accounting rate of return of 12.5%. Let's compare that to the scooter investment. So for the scooters, a lot of it's the same, but we see that we have to calculate an average annual net cash flow. So we take the $1,610,000 divided by 5 years, and our average cash flow is just $322,000. The depreciation expense is the same because the residual value for the scooter equipment is 0 also. Divide by 5, we get $200,000, so that didn't change, and then the initial investment didn't change. We compare the skateboards accounting rate of return of 12.5% to the scooters at 12.2%, and we see that the skateboards are slightly leading. The larger the accounting rate of return, the better. One thing that we have to consider is that there's potential in these proposals for managers to have some flexibility that they could use to their advantage, let's just say it that way. For example, residual value of the equipment is based on an estimate. If managers wanted to, let's say, change the estimate for the residual value, let's say the scooter manager wanted to change it a little bit so that he or she would win, the proposal with the budgeting committee. Let's see what the results might be. When the managers for the scooter proposal change the residual value to $175,000, we see that changes the depreciation expense. It reduces the depreciation expense, and that's going to have a positive influence on the accounting rate of return. Now the accounting rate of return for the scooters is 15.7%. So by changing the estimate, they've been able to have an impact on the results. This is something we need to keep in mind. A lot of times we have estimates with some flexibility in them, and we need to be aware of this. Now the nice thing about the accounting rate of return is it uses accrual basis accounting, which is very common and very understood by most managers and most investors. It also considers profitability. But one of the problems is that it doesn't consider time value of money. Again, the cash flows that come in later on in years 2, 3, 4, and 5 are given the same weight as cash flows that come in on the first year. The time value of money says that that's not accurate. In time value of money, we say getting money sooner is better than getting money later because we can utilize it sooner. So not considering the time value of money is a big weakness. The accounting rate of return is also more complicated to calculate than the cash payback period. The next ratio we're going to look at is called the net present value. The benefit of the net present value is it looks at the proposals using time value of money. So let's look at this example. We have the Blue Note Music Store. Now, the Blue Note Music Store sells musical instruments, but they're considering adding another building, an extension to the building, in order to give private lessons. If anybody's ever been to a music store, you know that it'd be very hard to give private lessons inside a music store because people are always tinkering with the instruments. By offering private lessons, that could really enhance the business for the managers for the Blue Note Music Store. They could get clients from learning how to play the instruments to buy new instruments. So the investment to extend the music store would be $420,000. They expect an annual cash flow each year, the same amount, of $125,000. They expect the useful life of this to be 5 years, and they want the return of their $420,000 to be 14%. Managers or owners are not going to make investments unless they can get a certain return. Otherwise, it's not worth their time. They'll put the money into some other investment. The residual value of the building is expected to be $50,000. So we'll look at the annuity first, the cash flow coming in. The cash flow coming in is $125,000. It's called an annuity because it's the same amount every year. If it's the same amount every year, then that's an annuity, and we can use a present value table for annuities. So let's get the present value factor from a present value of an annuity table. So this table was generated using Excel. However, present value tables are available in a lot of places. You can just Google or do some kind of web search for present value of annuity tables and find them. Most textbooks have them. If you look at this one, what you want to do is you want to go to the percentage that you want, 14%, and then you want to go down to how many years. So that's 5 periods, and see where they cross over. So that would be 3.433. That's the factor we want to use in the formula. So that means the annuity is worth $429,125 today. That's the present value of receiving 5 cash flows of $125,000 discounted for time value money. We also are going to receive $50,000 one time only at the end of the useful life of the building. Because the $50,000 is a one-time situation, we can't use the annuity tables. We have to use the present value of a lump sum, a one-time lump sum. So this table is a little different. It shows the present value of a one-time amount. So we go to 14%, 5 periods, and we get the factor for one-time payment or receipt of $50,000. That's the factor we want to use. When you add the present values up for the annuity and the residual value, you get $455,000. Subtract the initial investment, and what we have is $35,075 as our net present value. Whenever the net present value is positive, that means we're getting at least the minimum required return. In this case, we're getting more than required return. What if the cash flows for the music store were going to be different? The cash flows were going to be different amounts each year. Well, we can't use the present value of the annuity tables. Instead, we have to look at each year individually, and we have to consider how much each year's cash flow is going to be worth discounted for the present value. Year 1, we have cash flows of $80,000. So what would our present value factor be for 1 year from now of $80,000? So 14%, 1 year from now is 0.877. 2 years is 0.769. 3 years is 0.675. So we'll just use those present values for each year's cash flows. So we use those present value factors for each year's cash flow, and we also include the residual value that's coming at the end of year 5. And we see that the total present value is going to be $429,225. The initial investment is $420,000. So we have a net present value in this situation too of $9,225. The positive net value means that the required rate of return at 14% is being met. The higher the net present value, the better. And if you're comparing multiple options, you would say that the one with the higher net present value is better. One of the good things about net present value is it uses the time value of money, but it doesn't give the actual return. In our example, we just saw that we got at least 14%, but we didn't know if it was 15, 16, 17. It also is more complicated. So, that complicated. Another tool we can use is called the internal rate of return. With the internal rate of return, we'll see what the rate of return actually is, and then we can compare it to the minimum return. So in calculating the internal rate of return for the Blue Note Music Store, we have to make a little bit of change. We're going to look at a simplified version of internal rate of return. We change the residual value to 0. So the first step is to calculate the factor. So step 1, take the initial investment, $420,000, divided by the annual cash flows, $125,000. This is going to give you a factor of 3.360. Now we know it's 5 years, we just don't know what the return is. So if we go to our annuity table and we go to the period of 5 years, we want to get as close to 3.360 as possible. So we go along the 5-year line, the 5-year row, until we get as close to 3.36 as possible. In this case, it gets closest at 3.352, and we see which column we're in. We're in the 15% column. So for step 2, use the factor that we got in step 1 with the table. Use the number of years provided as the useful life, and then see which column you're in. And we were about the 15% column. So this investment is going to give us a 15% internal rate of return. As we said, if we have multiple projects, we can compare these returns to see what each return brings us. And we can also compare it to the required return and see if we're meeting that minimum required return. In this case, we are. So the benefits of the internal rate of return is it uses time value of money and it gives us an actual return. Internal rate of return is very, very common in investment and management decisions. But the downside is that the internal rate of return is much more complicated, especially if you have different cash flows coming in, and also if you have residual value or other types of income that are coming throughout the life of the project. For this reason, most of the time we use internal rate of return calculators or apps in order to simplify the process. For our purposes of this class, we just wanted to get a feel for how internal rate of return would be calculated, so we did a simplified version. Capital investment decisions are universal for all managers. At some point, managers will have to invest money back into the business. If the business is profitable, some of those profits need to go back to make the business expand or more innovative or more efficient. Capital investment decisions are exciting. Managers and employees are always excited to see the company that they work for doing better. It also means that the company is more secure. When you see your company investing in itself, you feel your job is more secure than if a company is just holding on.